Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Friday, August 13th, 5:24 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida with the Big Show. That's the Friday edition of the Revere Market Insight video where we take a look back at what happened the prior week, take a look ahead at what you need to know for next week, and update the world famous 21 over 21 leaders list. We just finished another fantastic podcast a couple of hours ago that will get posted to the website this evening and will be available. The emails will go out tomorrow morning if you want to wait for it, but a lot of good stuff to talk about in that podcast. Let's get right into it now. State of the market continues to be in an uptrend. However, with small caps lagging, we just can't get those back above the 21 and 50-day moving average is on any consistent basis, and that's mainly because of oil lagging. Oil plays a large part, especially in the Russell 2000 in small caps. Financials did their part this week, but so did some basic material stocks and industrials, but we just couldn't get oils going. So let's check over here at the trend gauge. You can see the leaders continue to be pointing to bullish. We're seeing some rotation in leaders this week. A couple dropped on earnings below their 21 and or 50-day moving averages. Some dropped below and recovered, and some new ones came to the fore. So all in all, leaders doing what they need to do. Looking at the short term using the 21-day exponential moving average, the medium term using the 50-day simple moving average, and long term using the 200-day moving average across all 5 of the major indexes, we're solidly in an uptrend there. The yellow arrow indicates the weakness in the small caps. If small caps could get it together, we could really have another strong up leg here. For now, what we're seeing is what you see under the what just happened over here, rotation and consolidation. Money moved out of some tech stocks this week and into some of the cyclicals, and then we consolidated that move in the cyclicals over the last couple of days. Some money came back into tech, not in oils though, and we actually saw staples and utilities put up a good last couple of days here. Very interesting to see that. So a lot of moving around. Tight range day on Friday, only about a 0.2% from the high to low in the S&P. So kind of a dog day of summer, slow Friday. You can see the final numbers here. S&P up 0.16%, NASDAQ 100 up 0.34%, Dow barely in the positive, mid caps down 0.2%, Russell the laggard, again led by to the downside by oils. Let's take a look at the big 11 sectors to see what outperformed this week. We'll also take a look at the major indexes, and then we'll get into the 21 over 21 list, including buys and sells this week. And I'm going to do an update on our balance at risk calculation to see where we stand on what we hold, and should we go to the downside, what our exposure is. So first of all, here is the team at Revere. As always, we'd like to talk to you. This is going to be a long video, so I'm not going to spend a lot of time with a sales pitch. Just after you watch this video, if you're interested in getting more information on what we do, or if you want to send it on to somebody that you think might benefit, please do. You can email any of us, Dan, Tim, Hunter, Mural, Alex, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. First, let's start off with the indexes as always. Why do we start off with the indexes? Because 75% of stocks are going to follow the overall trend of the market. Once you see the market with a trend up, then you drill down into the 11 major spider sectors. From there into 33 sectors underneath that we follow, and that breaks down into 197 industry groups. So we're always looking for the best stocks in those leading sectors and subsectors, and we ride them as long as they're healthy. When the market starts to go sideways or turn down, we lighten up, lock in profits, always keep our stops in place and get into the defensive mode. But you can see here, really what we've been taking is 2 steps up, 1 step back for the market for quite a while. And all the 50-day moving average playing a key role in this. Any weakness is being held by the 50-day. You can see on here only 1 close all the way back since March of the 50-day moving average. We had a very brutal stealth sell-off here in the middle of February to end of April period. It was a bear market for growth stocks. Not really noticeable if you look at the Dow or the S&P 500, but believe it, we felt it. And it was giving back some of the big gains that we got last year in the growth stocks. But for now, we're just trending higher along this. This thin purple line is the 8 EMA, closing at all-time highs today. The 21-day short-term moving average, that's the green line. 50-day moving average, simple, is the red line, and the black line, the 200-day moving average, which we haven't been below since July of last year. So everything's good here. So that's the S&P 500. No problems there. NASDAQ 100, a little bit of weakness earlier in the week. Mostly Tuesday and Wednesday when leaders took a back seat to rotation into cyclicals, but we bounced right where we needed to off of this 21-day exponential moving average. Closed the week 3.5% above the 50-day moving average, just like we needed to. This is the key level to watch for next week for leaders. 364.30 is the low. Thursday's low on the NASDAQ 100. That's a very key level for leaders, and the 21-day exponential moving average is now above that. So some tight support there. Should we get below that, we'll definitely be taking action in the portfolio, because if that breaks down, I'm quite certain that you're going to see some leaders that we own breaking down. Dow Jones Industrial Average, all-time high since this breakout above this 351 level. In the DIA, mid caps, MDY, not making a lot of progress, but we've got the 21, that's the green line, back above the 50. No breakout here, but we're trending higher, not really showing much relative strength. That just means that it's doing what the overall S&P 500 is doing, and that's basically, as I said, taking 2 steps up and 1 step back. Small caps, really taking 2 steps up and 2 steps back, not doing a whole heck of a lot. We had a couple closes, 4, 5, 6 closes above the 21. Failed through the 21 today, again, the weakness of oil. The 50-day moving average, that's the red line, rolling over now. You can see it slightly sloping down. The 21 flattening out. Just can't get it together here. Let's take a look at first at the growth component. This is the growth half of the Russell 2000 IWO. Not a good close to the week here, and quite a ways off of the close above the 21 and the 50 last Friday. That kind of gave some strength, but we gave it right back up. You can see the lack of relative strength this week in small growth leaders, but there were some big exceptions, some things that we hold that had some massive gaps up and continued to the upside. Here's the IWN, the value component of it. Not as bad this week, but under the declining 50-day moving average, this looks a lot like the overall index itself, above the 21 but below the 50. Let's take a look at the major sectors. Let's get this down to a normal size here. And we're going to take a look at the spider sectors to see overall which dominated this week. This is in the alphabetical order of the ticker of the sectors, and what we're focusing in is what happened on a relative strength basis this week. And you can see basic materials 3 days up to start the week. This includes chemicals, and it certainly includes the base metal stocks, especially steel. Just had an absolutely fantastic week. Let me bring up that SLX. That is the ETF for steel. You can see pretty good move this week. Some of the heavier weights in there didn't have a good week, but things like Steel Dynamics, STLD, that's what we're looking for in NUE. We had Steel Dynamics. We booked 10% on it in 2 days. It went higher over the next couple of days. We rotated into CLF, which is had a better entry point. Okay, moving on. Let's go to energy here. You can see energy okay early in the week, not so good the last couple of days in the week. Can't get above this 21-day exponential moving average. Communication services, this is like Google, Netflix, Facebook, Disney, just trending higher above the 21. Financials had a really good week and then consolidated over the last 2 days. You can see this little breakout here. Started last Friday with the good jobs report. Spike up in interest rates, and the banks took advantage of that. XLI, nice 3-day move, consolidated over the last 2 days. Technology, weak early in the week, strong over the last 2 days. Staples, here's the one that really surprised me. Strength Monday, Tuesday, a little bit of a give back. Strength today, all-time high close for the staples. Real estate, consolidating. Weakness earlier in the week, a little bit of a trend up, bounced off the 21-day moving average. Utilities continue. Just really outstanding relative strength over the last 2 weeks. Healthcare took a break early. Good day, good close on Friday. And finally, XLY, consumer discretionary, just flatlining. The biggest component of this by far is Amazon AMZN, and you can see that's really just trading in a tight range also. So those are the spider sectors. Let's get to the 21 over 21 list. And first, let's take a look at the stocks that dropped out this week. Hold on one second. Yeah, 21 over 21. So here's what dropped out this week. Viva, VEEV, software stock. Not really sure. Didn't see if it got downgraded or anything like that, but 3 big volume days of selling. Sliced through the 21, bounced at the 50. Not what we're looking for, but this did have a nice run since its earnings gap. But we tried to catch the meat of the move if we were in something, and it held the 21 for a while. So that would have been about a 10 or so % gain. I'm sure that outpaced the S&P over the similar period. That's why what we're trying to always do is to get double what the S&P gives you over a specific time period with any individual position. Franco-Nevada, we had high hopes for this one, but gold stocks just can't get out of their own way. They announced earnings, actually closed above the 50, but look at the relative strength on this. Just terrible. And if you take a look at GDX, we can't get anything going there. If this you can see how choppy it's been too. Gaps up, gaps down over the last couple of days. That's not really what we're looking for. We're looking for some strength in a trend like we saw back here in March, April, and May. That's what we want, not this chop fest. So Franco-Nevada cut, and also cut was in mode. We booked our profits in this one. When it broke through the 21, bounced a little bit above the 50, but still closed a speck below the 21. And since we no longer hold it, and it's below it, it got cut off. How about the addition this week? Just one. We actually had 23 stocks on the list last week because of some things that we bought that we included in here, but Dexcom consolidating on light volume over the last couple of days. However, it did break the 8 and roll over. We took a position here when it got back above the 8 intraday. Very light pullback here. It's holding the 21, so we're down a couple of % on this. Watching it closely, but with the light volume drying up and the big volume on the move up on earnings, we're expecting better things from this, but healthcare has to cooperate, and it took a little bit of a breather this week. So that's what was added. Let's go through the list now. They're ranked in the order in which they've been added to the portfolio. Some more recent adds are numbered higher. You can see if it's flagged, we very much eat our own cooking in this. If it's flagged, we own it in-house. And here are the sectors and the subsectors. We've got 8 to 10 sectors, I believe. Let's quickly sort it by that, and we'll see how many of the major sectors we are in here. 1, 2, 3, 4, 5, 6, 7, 8, 9 sectors, and 18, 19 industry groups. So let's go going through them. Starting off with the newest entry, that's Dexcom. I just took a look at that. Next up, Datadog. Uh, Took a position in this after the gap up. We're underwater for a while on it, but normal action. Big move up, 15%, 400% volume. Pulled back, bounced off the 8. Here's the shakeout day. Undercut the 8, closed back above it at the top of the range, followed that up Thursday and Friday, and now all-time high closes. We got a 5% size on this we've added to it. First 3%, then 2%, then another percent, brings us to a full 6% position in Datadog. Zoom Info, ZI, this has been a wild one with secondaries and earnings and gaps up, and finally looks to be calming down, trending higher over the ADMA. Steel Dynamics, as I mentioned, took our 3-day 10% profit in this. It's continued higher. It looks good. We own CLF. This really nice lower volume pullback right into the 821 in EMA and the move up off of it. It was our entry signal, and Steel's had a great week. Square, a little bit of a disappointment here. Nice move up on earnings, 2-day consolidation, follow through to the upside, 2-day consolidation. But on very light volume is the good news. The bad news is it's just been trickling lower over the last 4 days, but still holding the 21. We've done multiple buys on this one and still holding them all. Zscaler. I sold this week when it briefly undercut the 21, really just to take some risk off. Bounced with a strong close off of the 21. In hindsight, should have held it. Sometimes I wait till the end of the day when something breaks the 21. This one I did not, but in hindsight, wishing I did. This still looks fantastic, and that's the second bounce off the 21. AMD, bought it on this pullback, tightened up a little bit, added to it this week on this move off here. Nice follow through with volume off the ADMA today. LC, this is just a beast. Wish I had a bigger size in this, but it's got like a 10% ATR. Those are wild ones. Tightening up a little bit and just continues to trend higher along the ADMA. Snapchat, another one that's been a bit of a disappointment. Big volume, almost 600%, up 23% on the day, just consolidating that move sideways, looking like a tight pattern over the next 3 weeks. Volume drying up also above the 21. DT, sold this one this week when it poked below the 21, another one that ended up closing the week above the 21. So it's still on the list, but we no longer hold it as we rotated it out of some tech into some other things. Costco, this thing just continues to be a beast, riding the ADMA higher. ALB continues to follow through on the EV craze, great relative strength there. Carvana, big move up on earnings, a little bit of volatility after that, finally tightening up to close the week. Lululemon, first sign of underperformance was today, but it closed at the top of the range on the day and still hugging the 8 EMA. This has gone sideways for 6 days now, really tightening up on light volume. AVTR, this is a medical stock that just continues trudging sideways. It's good to have some low volatility stocks like this in a portfolio. Net tried to move out this week, pulled back, bounced off the 21. This looks great. It's our biggest or second biggest position here. And as long as we hold the 21, we're in good shape there. DocuSign, sold this on the break and the close below the 21, closed right on the 21 by the end of the week. I didn't like these 2 days where, especially when you see it try to break out like this and it failed, because the saying that you hear me say from time to time, from failed moves come fast moves. Followed that reversal up. I took half off that day, sold the rest of it on the break below the 21. Sitting right on the 21, but also notice the 21 is starting to curl over. This might just need a little bit of a base to form here, maybe a 6-week flat base, but sitting right on the 21. Not broken, just taking a pause. CMG took a little bit of a pause this week. One close below the 8, but bounced back above it by the end of the week. Domino's Pizza almost did undercut the 21, but closed above it. Volume drying up here. No progress after this big move up on earnings. AMT broke below the 21, bounced perfectly at the 50-day moving average, and reclaimed the 21 by the end of the week. And finally, FTNT, nice flag here after this earnings move and a nice action over the last couple of days. So that's your 21 over 21 list. Let's talk about what we bought and sold this week. I talked about getting out on DocuSign, Zscaler, and DT as they broke below the 21. Earlier in the week, we added to Square, added to Net, sold our last bit of Roku on Monday, and this thing really just has not held up at all. Sold it on Monday here. We owned it here, sold it, gap down on earnings. We bought it back. This looked like the earnings gap down, get everybody out when it closed back on the 50-day moving average. We were looking for this to immediately bounce off of here and do something, but then when it didn't on Monday, when it broke back below the 50, and then tried to get that was last Friday, and then Monday tried to get back above it and couldn't. We just closed the position out. Now it's sitting on the 200-day moving average. This is distribution volume, not crazy, but not what you look for. By my gap rules, this gap down, the low of that gap day should have held. If it's going to hold and it got everybody out, it should have bounced. Once it reclaimed this 50, should have taken back off to the upside. Because you can see there was very clear. Some people were trying to buy this over the last month and a half. Look at this move up and the volume there. Look at this move up, the breakout and the volume there. But for whatever reason, people decided to hit the exits on Roku, so we joined them. Franco Nevada, I talked about getting stopped out on that. Let's show that chart very quickly again. And took a little bit off Snapchat as that really didn't want to make any progress. Still holding half size on that. Upstart was one of the buys this week on this frankly unbelievable move. Gap up on earnings, and then a day 2 higher high and a day 3 higher high. Fantastic volume. Their numbers were just gangbusters. Very small percentage in this because between this and LC, the other one that we own in the group, they've got like 10% ATRs, and those are some serious bucking broncos. Later in the week, we got into Denbury, DEN, when it early in the day had some nice volume breaking above the 50 as oil looked like it wanted to do something, but oil after that opening hour just really sucked, and today also. But Denbury is one of the top 3 in the oil group, and it's sitting right on this 21 day. If oil does anything, I would expect Denbury to be a leader. The other 2 are CHK, which frankly I wish I would have bought instead of Denbury on Thursday, and then the other one is LNG. Those are the 3 best looking oil charts. Let's see what else. Also took a half size in Generac on this pullback and how it tightened up. So this had a big shakeout on earnings, sold off after that, bounced at the 50-day moving average, got back above the 21, looked like it wanted to do something, but now a single close below the 21. We get another one below. I've got a real tight stop on this one, as well as CAT. Half position in this. We had a nice move up out of this consolidation and a lighter 2-day pullback, so we added this one later in the week. And I talked about how we added Cliff, CLF, as steels continued to run, and this took a nice little 2-day break here right above the flat base pivot, so good low risk entry on there. And then late in the day, FAS we took. So the financials 5 days up, a little bit of a pullback here. This is right at the top of the base. This is basically the 3 times XLF or IYF, and you can see they're right at the top of their base too. XLF and IYF really at the top of their flat bases. So this is really a play on interest rates. If interest rates continue to come down, we would expect our techs to do well. If they go up, we would expect FAS to do well. So a little bit of a move to dampen portfolio volatility. So that's going to wrap it on looking at the charts. Next up, to finally close, I want to bring up where we stand on our balance at risk calculation. So I first presented this in the middle of June, And this is based on one of our clients that has about between a $900 million portfolio, $900,000 million portfolio. So on 6/18, the balance at risk on this one was around 930K. But since then, we've made progress in the portfolio. It's up to, I think, 1030, a million 30, and the balance at risk on the downside is 4.5%. So that means if everything got stopped out, that it'd be about a balance of 984K. So this is how we lock in profits. In 6/18, when I presented this, the balance at risk would have taken it down to about 933, but as we make progress on it, we sell things, lock in profits, cut losses. The progress of it means that so in 2 months, your downside in the portfolio has improved by about 50K. So what we have here, let me explain this to you. We track when we buy something, the position size of it, obviously. We track what the S&P is doing, because we want to be outperforming the S&P on a 2-to-1 basis. So we keep track of where the S&P was when we buy something, and here's the return of the S&P versus when we made the particular buy. Here's the size. Sorry, here's the size. Here's the ticker symbol. And then here's whether we're up or down on the trade, the date that we bought it and the price that we bought it. The overall size on a gain or loss basis to the overall portfolio. So for example, if you have a 5% position size and you're up 6% on it, which we show here, that's a 0.3% add to the portfolio. So it's position size times gain equals the benefit to the overall portfolio. Here is our stop. This column here where it says sell. If we got stopped out on, here's what our drawdown would be on that change. This is the drawdown on the position. This is the drawdown of the overall portfolio based on the position size. And if we get stopped out, here's where what our gain or our loss could be. So if we're in green, this means that we've assured ourselves a gain in this particular position. And then basically over here on the far left is the current price and the current stop. The stops are a combination of, depends on the volatility of the stock, the progress that we've made, and the chart. So it can be anywhere from 2% below the 50-day moving average to 2% below the 8 EMA, depending on the progress of it. So the bottom line is that when you add them all up, all of these balance at risk on the portfolio level equals a 4.12 approximately. I mean, it may be a little bit more, maybe a little bit less, depending if we buy things. But as of right now, if we were to get stopped out on everything on our published stops in this column by the end of the week, the drawdown would be 4.12%. So that would take that 1,026 or so portfolio down to 984 before all the stops would get hit. So REBAR stands for Revere Estimated Balance at Risk. This is how we know what our exposure is at all times to the market. That's going to wrap it. As always, I'd like to hear from you. You can hit me up on Twitter at dvandenbord, email don@revereasset.com, phone 855-REAL-WEALTH. Ending the week of August 13, this is Don Vandenbord reminding you, you'll never remember your small losses, but you'll never forget your big ones. So eliminate big losses from your portfolio, and it goes a great way towards helping yourself on your goals, your investing goals. Have a great weekend. Thanks for listening.